above old highs when the market's dropping, like it does here. If anyone went short there, where would they place their stop? Theoretically, to protect themselves. The books teach us what? Put your stop loss at the high or just above it. So the market drops down, rallies from here, and all of this area here, that's absorbing and engaging all the buy side liquidity or buy stops that will be resting above these relative equal highs. So that's what's occurring here. So when I teach my students and how I internalize price, when I see that, I'm expecting price to do what? Show a willingness to want to go lower. Because it went up here for real orders. I don't need level 2. You don't need level 2. You don't need depth of market to see that. It's plain. Wherever there are smooth edges, like these relative equal highs like this, the market, it's uncanny how it will go up there and make those smooth edges jagged. So it's all nice and smooth here, like a perfect ceiling, right? And then all of a sudden you see this smash running up, spend some time up here, and then breaks lower. This moment right here, when it takes out these lows on that candle, that is the market model that I gave you for 2022. Doesn't mean you get in. It means now you look at this price leg here. Go back through this price leg because this is the displacement price leg. This low has been taken out right there. So inside this entire run lower, you want to look at where there is an inefficiency or fair value gap. That fair value gap is your entry point. You just don't chase it just because it went down below here. Well, as I mentioned, we had relative equal highs. The market runs up in here. We don't do anything. We're waiting. Then the market drops. It does so here. Do we do anything with it? No. The market rallies again. What does it do? It runs above the rejection block in here. It's in my YouTube channel. And then there's a displacement lower. So this willingness to break sharply below a swing low after taking buy side. This is how you frame high probability. High probability for a short means some measure of buy side has been taken. We see that here. Then you wait for what? Displacement. That means, in plain terms, you want to see the market drop sharply lower and take out a specific low. Here's a short-term low. It trades through it here. Once we have that, then we can go back through all this price leg here and look for inefficiencies. That means a specific fair value gap. Now, once you have that price leg identified, you want to go through all your time frames. 5, 4, 3, 2, 1. Right now, I'm showing you on a 5-minute chart. So we have this price leg from high to low. High to low. This is the low that was shown as a break in market structure, not break, I shouldn't say it that way, a shift in market structure. So anything at this level or higher, we want to look at that as a potential what? Here's what it is. Inside this run from the midpoint of this leg higher and lower. Okay, that's the price leg that we're looking at. Why this price leg? Because it took out this short-term low on that candle. It's a shift in market structure, bearish, lower prices are expected. We do not look at any rally up as a sustainable run. Why? Because stops have already been taken above this high here. Then there's a shift in market structure below that low. That means that any rally after establishing the midpoint here, once it goes above that, in my mind, I'm thinking we're only going up to go down. So algorithmically, the market will print and produce a premium market. A premium market is where you want to sell your long positions as partials or enter your short positions. When the market's rallying, that's where you want to short. You don't want to sell in down candles. That's chasing price. When you see me doing my partials, when I'm pyramiding into a position, I'm selling short in the up candle. And then price run down. We're waiting for price to go back above equilibrium, which is the 50% level on your fib. There's no mystery to it, okay? This is the only benefit of having a Fibonacci in my mind. That and how I use it for targeting. And I'll show you that stuff. And you've probably already seen many times me doing it in my live executions and managing the position, trailing the stop, looking for targets to be hit and such. But this run above equilibrium within this price leg here, that sets the stage. Okay, now we are in a premium market, meaning this range is premium. It's, in other words, overbought. I don't need an indicator. You don't need an indicator to derive that. from this point here to here, this is discount. As soon as we leave, and again, this discount, okay, in the red shaded area above this level here, that's a premium. Above it or at that level, they're your ideal shorts. As soon as you cross the midpoint of the discount level here, once we get through that, I did that by eyeball. That was pretty good, wasn't it? Once you get through that there, the highest form of profitable shorts, the highest probability short entries, they have now been exhausted. The only thing you want to be focusing on now is taking partials and trailing your stop. Yes, that's a diamond. You just simply can't just take every single trade and enter and enter and enter and enter. When do I stop taking partials or pyramiding? Something like this. Now I'll build pyramiding entries all in this until we get through here, and then I stop taking pyramid entries. Go back and look at my examples and you'll see that's the truth. So when I wanted to learn how to pyramid and build my positions large, the idea of looking for the best entry points, the highest probability, and how the market will respect those levels more so than others. See, once we leave the midpoint of that discount range of this price run here to here, and we're in the lower portion of it, we're entering that expansion phase. That expansion phase is likely to not offer very many, if at all, new high probability pyramid entries to add to a position. So there's a threshold at which I will no longer add to new existing positions. But while I'm in that premium area, within that price leg, within the market structure that I'm looking for, as I just outlined here, and again, you're going to want to watch this portion of the video several times, it gives you the highest degree of probability for delivery from your entry to your targets. And you don't want to chase the move and build in more position once it breaks through the threshold I just outlined here. Because to do so, number one, you're going to be worrying about trying to put on another position versus taking off some as it moves in your favor. Once the market starts to draw back up into this premium area, we have to go through our time frames and look for fair value gaps. So right away we have this low to high. Let's go back in with the fib. So we have to go into a fair value gap at or above equilibrium. So from this point on up, we can look for what? A fair value gap. Is this a fair value gap? Yes. What if you sold short there? Would it be profitable? Yes. Where would your stop need to be? Here it needs to be at the high. That's a lot. That's a lot of range. But I don't want to have a stop loss like that. Okay, but you're going to have to be more selective with your entries then. Now look closer. Inside this price leg here, this is why I'm not supply and demand also. What is this? What's that? What's the separation between this candle's close and this candle's opening? Volume imbalance. The volume imbalance has no body between two close and or opening prices. So it can be a volume imbalance between a higher close and a lower opening, or it could be a difference between a close with a higher opening. That's the difference between the two potential volume imbalances. The wicks overlap. See how it has a small little wick right here? Let me see if I can. How can I do that here? There's a small little wick here and a small little wick right here. Whenever I'm looking at price, I'm looking for those types of things because that's a signature. That's a little glitch in the matrix. Think of it like that. So if you take that and draw it through, because we cut through candles, Sam. We're not supply and demand around here. If you cut through all this drop as it's retracing back up, what's it reaching for? It is reaching for an imbalance in here. Yes, there's one here with this candle. There's one here between this candle's low and this candle's high. And then we have one here to here specifically with that candle. Which one is better? Yes, you can enter here and have a stop loss up here, but look closer. In this delivery higher, when it ran higher, what is this last up close candle anyway? It's a bearish order block. Why is it a bearish order block? Because it has a fair value gap. Opening price on this candle is what? You're going to look right here. Opening price on this candle is 4130.00. Okay. What's the high on this candle here? You're looking right here. The high of that candle is 4130.00. You cannot improve on perfection. That's algorithmic. What's the high on the next candle here? 4130.00. Again, not one tick off, not one tick over, not one tick short. So if you have a series of fair value gaps, which one do you look to trade to or use your entry at? Look for the bearish order block, look for a volume imbalance, or a fair value gap on the other side of the drop. You extend it through. Again, we cut through candles. So with that volume imbalance and the fact that it's above equilibrium on that price leg right here. So the first one you come to, you could go short there and your risk would be to that high. Trading at this one with the volume imbalance and the fair value gap, and now watch. What's the half of this up close candle? Remember what that was? What's the half of an order block? It's not consequent encouragement. Consequent encouragement is any inefficiency. A fair value gap, buy side imbalance, sell side efficiency. Those are consequent encouragement midpoints. A candle, a range, a specific candle that's been delivered in price, the midpoint of that is mean threshold. Low to high is 41.31.5. So if you were taking this fair value gap, joining it with the volume imbalance, and it's a bearish order block, price should not do what? It should not trade above the midpoint of that up close candle. So your stop could be at 41.32. 41.32. So that means you have a 2-handle or 2-point stop loss entering within this volume imbalance, within this fair value gap. So that's how we go through the process of looking for the right fair value gap. Now, if there's no volume imbalance, or if there's no fair value gap here on the other side of the displacement leg, then I'll use the first fair value gap above the equilibrium. And then there it is. Now, another version of this would be using this. And I usually do this if I'm going to be building a large position. Like if I know I'm going to be building a large pyramided position up, I'll use this run up where it takes, right before it drops down, it takes a shift in market structure. So this is the displacement leg. Okay, this leg here, you split that in half. You would use any fair value gap, any fair value gap at this level, and here's your sell side. Look what we just talked about there. Let me finish this thought here, and then I'm going to talk about this volume imbalance I mentioned. This leg here to here, if we had no volume imbalance, if that wasn't there, I would take this low to that high, the equilibrium there, drag that through. This would be the fair value gap at that moment. So then I would be doing this. Again, this is assuming that there's no volume imbalance. My entry would be here and framed on this fair value gap there. Show me how to pick the right fair value gap. I just did.